Welcome back to the Deep Dive. Today, we are strapping in for what feels like a high-speed tour through a really fascinating world.
Absolutely. It's the world where crypto meets, well, your everyday wallet.
Exactly. We're exploring that crucial and, let's be honest, often messy infrastructure that's trying to bridge the gap.
A gap between the decentralized world of digital assets and the traditional, highly regulated banking system we all use.
And that tension between those two worlds is really where all the action is.
It's where the value is. And we have a pretty heady stack of sources today to help us unpack this.
What are we looking at?
We've got internal financial service documents for a platform called PintoPay, a detailed educational strategy template, and even a strategic deep dive into this huge idea of Web3 identity and digital passports.
Okay, so a lot to get through. Let's set out our mission for this then. We want to move past the hype, right? Beyond the buzzwords.
Yes, we need to look at the actual mechanics.
So we'll try to understand the competitive landscape of these payment solutions, analyze PintoPay's specific B2B model, their economics, and we're talking real numbers, real costs.
And then connect all of that, all those practical applications, to the massive, almost paradigm-shifting concept of self-sovereign identity, or SSI.
So we're essentially acting as educational experts today. We want to give you the framework you need to make, informed decisions.
Precisely. And that means we have to clearly identify the benefits, but also acknowledge the limitations. We've got to set some realistic expectations for what this tech can actually deliver right now.
Especially in such a heavily regulated space.
Exactly.
Okay, let's jump straight in. The new financial landscape. The key problem that a platform like PintoPay is trying to address is just the sheer friction of using digital assets in real life.
We've all been there.
Oh, yeah. You hold some crypto, but you can't just walk into a coffee shop and seamlessly buy a latte with it.
Not yet, anyway. The demand for that kind of fluid movement between digital assets and, regular cash is huge. And it requires these next-gen services to solve it.
So PintoPay is positioning itself as one of those services.
It is. It's explicitly designed to be that bridge. Its core function is to enable partners to issue their own branded virtual and physical cards.
And these aren't just some random cards, right?
No. We are talking globally recognized Visa and MasterCard cards, all made possible through an API that companies can integrate.
So the idea is, instead of a user having to go through a complicated exchange, sell their crypto, wait for a bank transfer, all of that hassle,
right,
their customers just get instant use cards.
And these cards can be topped up instantly with either crypto or fiat, and they just work worldwide through things everyone already uses, like Apple Pay, Google Pay, or just a physical card you can tap.
That's the real utility people are looking for.
It is, and it's important to note this isn't just a simple prepaid card. The crucial part is the secure neobank infrastructure that's backing the whole process.
Meaning all the transactions have to be compliant, they have to be fast, and legal across dozens of different countries.
Exactly. So PintoPay is trying to bring that crypto ethos of efficiency into the accepted, regulated rails of traditional finance.
And this isn't just a concept. They have some numbers to back it up.
They do. The sources say PintoPay reports about 117,000 total users.
Okay, but it's the engagement numbers that really caught my eye.
That's the key, isn't it? They have 38,000 monthly active users, MAU, and 12,500 daily active users, the DAU.
Which are pretty decent metrics. But here's the number that I think tells the real story. The B2B growth indicator.
Yes.
Yeah.
The 11 plus B2B integrations per month.
Right. What does that actually mean in practice?
Well, to put that in context, it means they're onboarding a new business partner every 2 or 3 business days.
Wow.
That high rate of adoption tells you exactly where their focus is. It's not just about getting individual customers, it's about building the foundational backbone for other businesses.
Businesses like crypto wallets or DeFi protocols or maybe even loyalty programs.
Any of those, it's an infrastructure play.
And that strong B2B rate leads us perfectly into the core financial structure. Because PintoPay's model is all about supporting these partners.
Right. They give them this ready-to-use infrastructure to integrate card issuing directly into their own systems.
And in doing so, it creates a new and pretty crucial revenue stream for that partner.
It really does. Instead of issuing cards being a cost, the partner actually earns revenue from every single card that's issued and topped up.
It completely changes the dynamic they have with their user base. They can offer a really useful, sticky service and generate income from it.
That makes perfect sense. But, if I'm a big crypto wallet or some fintech startup, I've got choices. There are other card issuers out there. What does PintoPay offer that sets them apart?
That's where their competitive positioning really comes into focus. And our sources are very clear on this. There is no single best option.
It all depends on the partner's needs.
Entirely. It depends on their context, their budget, their internal tech team. And PintoPay really offers two main integration types. And the differences are, well, they're pretty stark.
Okay, so let's start with the lean option. What's that?
That would be the API solution. It's priced at $9,500.
9.5. Okay.
This is for projects that already have a strong in-house tech team. They're already deep in the development process.
So they can just plug this into their existing crypto wallets and get the raw card issuing function.
Exactly. But there are some big limitations. If you pay that 9.5, you're getting the engine, but you're not getting the shiny exterior.
What do you mean?
The limitations are significant. You get no built-in client interface, so your team has to build the whole user experience themselves.
Okay, that's a lot of work.
A ton of work.
Yeah.
You also get no custom branding. It's just the tech. And critically, the support is limited to L2.
Wait, let's define that for everyone listening. What's the difference between L1 and L2 support in this kind of context?
Good question. L1 is level 1. That's your frontline customer service. Think password resets, general questions, helping a user navigate the app.
The basics.
Right. L2, level 2, is purely technical support. That's the engineering team that helps your developers integrate the code and troubleshoot API problems.
So if you choose the API option, you're responsible for dealing with all of your end-user complaints yourself.
All the headaches, yes.
Okay, so if the API is $9,500 and requires my own tech and customer service teams, what does the higher tier offer?
That brings us to the white label solution. And this is a pretty significant jump in commitment. It's priced at $30,500.
35. Okay.
This is a full ready-made solution. For that higher cost, the partner gets everything built for them.
What's everything?
A complete, polished, built-in client interface, full custom branding, and this is the big one, full L1 and L2 support.
So they handle the user complaints and the technical issues.
They handle everything.
It's interesting. I mean, $30,000 seems like a really sizable entry fee, especially for a smaller crypto project.
It is.
Doesn't that immediately favor the big established players with deep pockets? It kind of feels like it could hinder true decentralization.
That's a great point. It definitely raises the barrier to entry, but PintoPay's positioning seems to be targeting platforms that already have an established user base they want to monetize or serve better.
Okay.
And the white label solution also includes a fully functional Telegram mini app right out of the box.
Ah, so that reduces the time to market.
Drastically. It cuts down development costs for the partner, which makes that $30,000 less of a pure cost and more of an investment in speed.
You're trading capital for speed and less operational friction.
Exactly. And that time-saving efficiency is key, especially when you look at the specific financial benefits the partners get. Let's get into those commission details.
Absolutely. The sources show some really clear cost reductions when you compare the standard fees to what partners pay.
Like on the virtual cards.
Yeah, look at the virtual card costs. For a virtual card that works with Apple and Google Pay, the fee for the card itself drops significantly, from the equivalent of $25 down to just $12.
Wow, that's more than a 50% drop on the issuance cost alone.
It is. And we see similar reductions on funding the card. The deposit fee, that's the fee the user pays when they top up, that also drops.
From what to what?
Depending on the card, it moves from 2% down to 1.5%. And these are the specific financial nuggets that make the integration worthwhile.
Because those savings can be passed on to the customer, making the product more attractive, or they can be absorbed as extra profit by the partner.
Right. But the real incentive here is the monthly passive income stream this can generate.
Okay, so what is the actual forecast?
Yep.
If a project implements this successfully, what can they expect?
The forecast in the document is pretty powerful. It gives an example. Let's say a partner onboards just 1,000 active users.
Okay, 1,000 users. Seems achievable for an established project.
Right. And let's say each of those users spends, on average, $1,000 a month through the card.
So that's $1 million in total transaction volume per month.
Exactly. Based on the 1 to 2% commission rate that the partner earns on that volume, the estimated monthly income for that partner is between $10,000 and $20,000.
$10,000 to $20,000 a month. a potential $250,000 a year in new revenue
Yeah.
just from facilitating spend that was already happening.
Yes. It completely changes the calculation for that $30,000 white label fee, doesn't it?
It puts the ROI into a much clearer perspective.
It moves the conversation from how much does this cost to how fast can this pay for itself?
Okay, so we've covered the technical bridge and the very compelling economics. Now let's widen the lens, because this is where it gets, for me, really interesting.
I agree.
We need to connect these payment rails to the larger, more philosophical context of Web3 identity. This isn't just about spending crypto. It's about ownership and control.
This transition is so vital because they're intrinsically linked to our identity and our data. And according to our sources, in this evolving world of Web3, your digital identity is fast becoming your most valuable asset.
This is all encompassed in what they call the digital passport strategy.
It is. And the buzzword that just dominates this space is self-sovereign identity, or SSI. We defined it earlier as the user owning their data, but how do we get beyond that simple definition? How does SSI fundamentally challenge the way things are done now?
It's revolutionary because it completely flips the traditional model. In Web 2, centralized companies, Facebook, Google, your bank, they control your identity.
They store your data, they monetize it, and you just have to trust them.
SSI says the user controls their own cryptographic keys, and those keys govern access to their verified credentials, which massively enhances privacy and security.
So the digital passport is just the container for those user-controlled credentials.
That sounds fantastic in theory, but now we have to bring in the real-world friction. PintoPay is working directly with giants like Visa and MasterCard.
Right.
And these institutions are governed by incredibly strict protection. Know your customer KYC and anti-money laundering AML regulations all over the world.
So how do you marry a decentralized, self-sovereign identity where the user is in charge with a traditional centralized requirement for identity verification?
That is the central tension that's defining this entire decade of tech.
It is, and PintoPay's approach is to be at the forefront of enabling user privacy within that required compliance structure. The key is in something called verifiable credentials.
Explain that.
With SSI, a user can prove they meet a regulatory standard, for instance, proving you're over 18 or that you live in Germany, without revealing the underlying document or any unnecessary personal data.
Ah, okay. So instead of PintoPay or a bank holding a copy of my passport on their server somewhere, my digital identity just issues a cryptographically secure statement that says, yes, this person has passed all the necessary KYC checks.
Exactly. The information is verified once by a trusted issuer, but it's held by you, the user, in your digital passport.
And this allows a platform like PintoPay to use these Web3 ideas to enable seamless private transactions that still meet the high standards of traditional finance.
It's a mechanism for controlled, selective disclosure of verified information.
And the implications of this digital passport idea go way beyond just spending crypto. If you can control your identity for payments, you can, in theory, control it everywhere.
The sources cite several broader use cases, major applications in DeFi, in gaming, and in social applications.
Because identity is really the foundational layer of all of Web3.
It is. Whether you're trying to vote in a DAO, take out a peer-to-peer loan, or even just verify your reputation in a gaming guild, that identity piece determines everything.
When you control your credentials, you control your access, your reputation, and your interactions across the entire internet.
This has been a really, really informative dive.
I agree. Let's quickly recap the three main areas we explored. First, we looked at the technology bridge itself.
Right. Using platforms like PintoPay to solve that fundamental friction between crypto and fiat, all through globally accepted cards. It's all about utility.
Second, we drilled down into the B2B economics. We saw the critical differences between that $9,000 API solution and the $30,000 white label option.
And we saw why that earning potential up to $20,000 a month from just 1,000 users makes these integrations so compelling for businesses.
And finally, we connected all of that to the strategic importance of data ownership through self-sovereign identity.
Our goal here was to give you a solid, realistic framework for understanding the options in this landscape, moving from the practical costs all the way to the philosophical implications.
So, as we finish up, what's the big question that you, our listeners, should be mulling over?
I think it's the challenge we just discussed. The biggest tension that's going to define the future of the internet is exactly how to successfully marry decentralized self-sovereign identity with the traditionally centralized, heavily regulated infrastructure built by companies like MasterCard and Visa.
Because they're almost opposite goals, complete user control versus necessary regulatory oversight.
Exactly. And how that tension gets resolved will determine who truly innovates and who ultimately captures this next wave of digital finance.
So a final thought to leave you with.
I'd encourage you to consider this. As platforms like PintoPay start enabling this future, how can you start taking proactive steps to build and to control your own verifiable digital identity today?